Welcome to the BamCam podcast with Jack Burnette and Alison Castellano from Eater Financial Wellness, a financial advisory practice at RFG Advisory. In this podcast, we explore how life and financial well-being are intertwined. We'll look into areas concerning motivation and attitude, financial planning, investing, and much more. Our goal is to empower you with the information and resources you need to help manage your money and strive toward the life you've always wanted. So sit back, relax, and join us on this journey of uncovering your true self and achieving financial independence.
Hello and welcome to the BamCam podcast with your hosts, Jack Burnette and Alison Castellano. I'm Wendy McConnell. Hi, guys. How you doing?
Good.
Good.
How are you, Wendy?
We are good. Now, I'm good. Are you guys all in one piece? Last we talked to you, you were skiing a swoosh, swoosh, swoosh.
We, as a matter of fact, Alison and I were the only two members of our skiing part of the family that didn't fall.
Yes.
Oh, no.
Yes.
all week. So that's good. Our son is the best skier, and he actually did fall.
But I don't know if it really counts. He fell standing in the lift line.
That's
Which
true.
sometimes happens.
Which is kind of embarrassing, but
That's worse.
nevertheless, son, Riggs,
Sorry,
Riggs, we still love you, and you are still the best skier in the family by far.
Okay.
So he listens to the podcast, so
Yeah.
Hi, Rick.
he'll get a chuckle. But we are going to talk today, Wendy, about taxes and taxation, which is a lot of fun.
No.
But this time of year everybody's starting to gather their tax information. As a matter of fact, some of my 1099s arrived in the mail while I was gone on our trip last week. And so I have to start gathering my information, as do most people this time of year, for either their own tax preparation or meeting with a tax preparer. And we thought it'd be a good idea to talk about taxation. And I thought of no one better to bring onto the podcast than my good friend, Jim Sumpter. Jim and Jim is a financial advisor like Alison and myself. He's with CMC Financial, which is a branded financial advisory practice here at RFG Advisory. Jim and I have been colleagues at 3 different firms over 20 years. He and I were together where we started our careers early on at Merrill Lynch, then at Ameriprise, and now here at RFG Advisory. And so Jim and I have been good, dear friends for a long time. And Jim, over the course of his career, has pursued a taxation practice, a taxation specialty, in that he pursued a master's in taxation and does tax preparation in addition to general wealth management and financial planning services. He's also a certified financial planner. He's got all kinds of credentials. He's very, very smart. And Jim, welcome.
Well, first of all, Jack, thank you very much for that introduction. I think it was it's very humbling when a friend, a colleague, we were talking prior to starting. Jack and I have known each other for over 20 years. Allison actually used to babysit my kids.
I did.
She was in high school.
And she was in high school. So our families go back for years. And I just appreciate you even, thinking about me and having me on today. So hopefully we'll be able to give some insight on something that we all have to do, but we don't all love.
All right, that's for sure.
Yeah.
That's for
And
sure.
this is definitely tax filing 101 for someone that is very anxious and has no clue what they're doing, which is a lot of people out there.
Right. Well, and a lot of our listeners to the podcast are certainly not experts to taxation, and we're hoping that we can provide some insight here. So the first thing is that people have to gather information as you're getting organized to either prepare your own taxes or go to a tax preparer. You have to, some of that responsibility falls on the taxpayer. So generally you have to gather things like your W-2s and things of that nature, any kind of investment reporting statements and the like. Jim, what are some of the things that people tend to show up and maybe forget to bring to you besides the obvious things?
Right. Well, everyone gets their W-2. They get a 1099 here or there. One of the things that I'm finding is back when you and I started, everything used to always come in the mail.
Correct.
Now, a lot of things are coming electronically. So what may happen is you gather the things that come in the mail, or you gather the things electronically that you look at all the time. But then there are things that generally we have to go back and ask for. I'm a believer that we want to try to get every single deduction that you're entitled to.
Of course.
So
Yeah.
things like, your car tag. Everyone goes in and pays for your car tag every year. You get the slip that you keep in the glove box. You don't look at it again until you go and you replace it the following year. And on that car tag, there's three numbers. There's the actual price of the tag, which is usually only about $24, $25. It's very minimal. There's this number called ad valorem taxes, which is a deduction under certain circumstances that could be used. And then a lot of people like myself, I have a tag for childhood cancer.
Right.
So there's a $50 charge to me. Well, that $50 charge actually goes to Children's Hospital.
Right.
That can be counted as a charitable contribution. And if I didn't have that car tag receipt, I wouldn't know that. Things like student loan interest. Now, the last couple of years, there's been a lot of student loan interest that's been deferred.
Right.
But that is starting back now in 2024. However, if you were paying private loans, you had to continue paying that. Well, you get the deduction for student loan interest. So there's a lot of little things along the way. Your medical expenses, it could be that you had a very large dental bill or something in that particular year. Things that you don't normally have, but you need to continue to think about. Things like your charitable contributions, things that don't come to you in the mail and may not show up in your email, but you still need to go gather.
Right. And some of these would apply as an itemized deduction versus the standard deduction. And in our state, in the state of Alabama, the thresholds for whether you can be on itemized are different at the state level and the federal level. People often just assume that they would take a standard deduction, but they might be able to take the deduction at the state level if they brought you the detail from that perspective.
That is correct. So in Alabama, let's say that you are a married filing joint couple. The federal standard deduction is $29,200 for 2024. It was a little bit less for 2023. So if you do not have enough of itemized deductions for the federal, Alabama's state number is only 3,000.
Oh, wow.
So by the time you add the 3,000, you very well could be itemizing on the state, even though you took the standard deduction on the federal. Now, every state is different. So it's very important that you speak with your tax advisor about your specific state, but that's the way that it works. And you always need to kind of look at those sorts of things. So, just because you can't take it on the federal doesn't mean you can't take it on the state. And it really could help you save a lot of money over time.
Well, in Alabama, then virtually anyone that has a mortgage would itemize at the state level.
Yes, that's pretty much the way it is. Now, if you're single, that number I'm looking here is 14,600 on the federal.
On the federal,
it's still the same actually it's half on the state, so it'd be 1,500 on the state.
Right.
So if you have a mortgage, if you give some charitable contributions, if you buy a car tag that has that ad valorem like I was talking about, it is very
or property tax on your home.
Or property tax on your home, it is very likely that you could itemize on your state. Again, you have to look at your specific state.
Right.
And, like if someone lives in the state of Florida, for example, you don't have a state income tax. If you live in Tennessee, you don't have a state income tax. But there's other taxes that could apply. So when you're gathering all these things, I've always found it best practice to make sure that you're still giving all of that information to your tax preparer.
So So a lot of people are even confused as to what the standard deduction versus itemized are. And so essentially, readdress that, Jim. The standard deduction is basically the government saying, we're going to give you this much that you can write off as a flat amount. And you don't have to itemize it.
Correct. So I'll use, they wouldn't let me bring a calculator in, you know, as an accountant. So I'll use, easy math.
Okay.
Let's say that as a married couple, you make $50,000 total. Okay. You're going to get and that's all of your income. You have W-2 income of $50,000. You're going to get a standard deduction in 2024 of $29,200. Let's round that to 30,000. So what that means is your taxable income is only $20,000. That's the number that you're paying tax on. Now, if you had itemized deductions that totaled more than that 30,000 in my example, let's say it totaled 35, you're only paying tax on the difference, which is $15,000. So that standard or itemized deduction is very, very important in determining your taxable income. So we want to try to get that number as large as possible so that you can get the biggest deduction.
So would it be safe to assume for your tax preparation clients that come in, you would like them to assume they're going to gather information as if they were going to itemize deductions? Because at the state level, they probably would.
Yes.
And so they very well may be taking the standard deduction at the federal level, but itemizing at the state. So they need to gather their information as if they were going to itemize. So that includes mortgage interest, medical cost, property tax information, charitable donations. Those are the biggest.
Yes, those are the biggest ones. I'll give you one other really quick example. Let's say that you have all of those things, but then you inherited a piece of property from granddad and you're paying property taxes to wherever that property is each year. That the property tax on that property also counts, even though it's not your primary residence. So it's all of these things that you want to try to gather. And I just find it a best practice. Give me everything. If we don't need something at the end of the day, fine. I gathered the information. We just didn't use it, but we had the information if it was applicable.
Mhm.
Good, good. Okay. One of the things that I've always heard is you get along further in the spring and somebody comes in and is bragging about, well, I got a $5,000 refund. And this other person sitting there thinking, well, wait a minute. My refund was only $300 or perhaps, wait a minute, I didn't get a refund at all. I had to write a check for $1,200. So why does that happen? That some people get these huge refunds and some people don't have a refund at all?
Yeah. This is one of my favorite questions. So when you receive a refund from the federal government or from the state that you live in, what that means is you paid them too much money and they're giving you part of your money back. So if someone got, in your example, the $5,000 refund, that means they gave the government a $5,000 loan, interest-free, and now the government's giving them their refund back. That's what that means.
Oh, so the refund is not necessarily very good.
You know, some people like getting that
Yeah.
refund just psychologically, but it means that they paid in too much.
Yeah.
Right.
That they didn't have to pay in.
So either their withholding was too much or they paid too much in quarterly estimates. That's for those that are self-employed or have extraordinary income, may have to do quarterly estimates. A lot of retirees have to do quarterly estimates. So if you get a large refund, you probably should reassess and rethink your withholding,
Correct.
right? Either through your employer or relook at your estimates and how much you're paying.
That's correct. So, when you start a job, day one, you fill out all the paperwork. So part of what you're filling out is what's called a W-4. And that's telling your employer, please withhold X amount. And it's based off of you're single or you're married or how many children you have, things like that. One of the things that I find is, let's say someone is single, they're working, but then they get married, but they don't go and adjust their withholdings.
Okay.
Or they may have a child, or they may have another child, and they don't go and adjust their withholdings. So what's happening is their employer is withholding at a larger rate than they're actually required to. And so you have this large sum of money that's paid into the government that then the government is going to give you back in the form of a refund, which means when you're talking to your buddies, you say, well, my guy got me a bigger refund. He's a better guy than your guy. And that's one of the things it is kind of frustrating when you have two people that work at a company, one gets a huge refund, one doesn't, and all of a sudden I'm the bad guy.
Right.
Yeah.
And it happens, and it happens every single year. So you have to say, well, you paid in too much.
So
And
reevaluating that withholding should happen with really every life event that happens in your life.
Getting married or getting unmarried would impact the taxation. Having a new dependent could impact that.
Or having a dependent that turns from 17 to 18.
Okay.
Because what happens is there's a credit called a child tax credit. And in today's law, you get $2,000 per child up to age 17. That number drops to $500 when they turn 17. Then it drops to $500. So what happens is the rules change, but a lot of times you don't realize the rules change. You don't know that you need to go back and adjust your withholdings. And so what happens is you're paying in either too much or too little. And so, last year you got this refund of $1,000, and this year you owed $2,000. Well, what happened? Well, your situation changed, but you weren't aware of it. So, Allison, to your point, I think it's the best practice to reevaluate this on an annual basis, working with whoever your tax preparer is, and say, here's my personal situation. This is what's going to happen. Do I need to make any adjustments?
Yeah.
And the preparer is going to know, and the advisor is going to know to be able to give that advice because they're going to know your situation.
But ideally, as financial advisors, we would recommend that you try to get it as close to net zero when you file the tax return as possible.
Ideally, yes. I use a number of $500. I say, if we can get within $500 between the federal and whatever state you live in, then you've essentially broken even, and most people will agree with that.
Right.
Yeah.
Right. Okay. Well, good. So one thing that as people talk about through their employment and whatever, they have different types of savings plans, and some are tax deferred and some are tax and not tax deferred. For instance, the opportunity that many employer plans have between Roth and traditional 401k money. Walk us through the taxation of that.
Yeah, that's a great question, because this is becoming more and more common for companies to offer within their 401k a Roth option. So what that essentially means is, let's say you make $1,000 in income and you're going to put $100 into a plan. Okay. So you earned $1,000, you put $100 into your 401k, your traditional 401k, you're only paying taxes on $900. So you're only paying taxes today. This is called a tax deferral plan. So you're deferring the tax to a future point in time. Then that $100 gets invested, and that $100 hopefully grows over time. And then when you take out that money, you're going to pay tax at that point. That's what we are traditionally used to when we talk about 401ks.
And the same thing in an IRA.
And the same thing in an IRA. That's right. That's right. So money goes in tax deferred. You're not paying the tax today. Now, you are paying Social Security and Medicare, but you're not paying the income tax. Right. Okay. Now, so what's a Roth IRA or a Roth 401k option? That same $1,000, you put the same $100 into your Roth, you're going to pay tax today on $1,000. So you pay tax on the $1,000. So that $100 that you contributed is taxed today, but it grows tax-free forever. That's the difference. Okay. So there's a tax deferral and then there's a tax-free.
So the
maybe so the younger you are, the better it is to have an option that's a Roth option.
Right.
Because when you're older, you've accumulated more wealth, you might be in a higher tax bracket than you are today.
So if it could grow, if let's say you're 30 years of age and you have an opportunity to save for retirement in a Roth vehicle, you're going to have 30 years of growth that will never be taxed. So not only will the $100 not be taxed that you originally put, but over 30 years, it may double 2 or 3 times potentially over that period of time and never be taxed. So the longer you have to save for retirement, in other words, the younger you are, the more beneficial that would be.
That's correct.
That does sound really appealing.
Right. Now, the other thing that you could do, and what some people do, is let's say that $100, and this depends on your company's plan. Does it offer this? But that's what an advisor, that's what a tax advisor is going to help do, is figure out what options you have. You could take that $100 and put $100 or $50 into the Roth bucket and $50 into the tax deferred bucket. Mm-hmm. That is certainly an option, and a lot of people do that.
Right.
Yeah.
Yeah.
Right. And I've advised people to do that as well with clients. And the employer match portion almost always will be pre-tax dollars.
Yes.
Because the company wants to get a tax deduction for what they're giving you.
100% correct.
So a couple of other things that we want to talk about is in the state of Alabama where we are, we have a 529 plan, and it's called the College Savings Plan. It's a 529 plan, and you get a state tax deduction for contributions made to that plan. Many states, wherever your state of residence is, may have a college 529 plan that offers a state tax deduction, correct?
That's correct. So, and I can speak specifically to Alabama and then a couple of other states. So in Alabama, you're allowed a $5,000 contribution that you can get a deduction on up to $5,000 per person. So if you're single, you can put in $5,000 into a 529 and get a state deduction, not a federal, but a state deduction. If you're married, you can do up to 10,000 because it's 5,000 per person. So if you were a married couple and you put $10,000 into a 529 plan, and you're in the 5% tax bracket,
which almost everyone in the state of Alabama is.
That's correct. Then you're going to get $500 credit on your tax return. So at the end of the day, if you owed $2,000 to the state of Alabama, you have a $500 credit. You only owe $1,500 at the end of the day. So a credit is dollar for dollar, whereas a deduction is less than dollar for dollar based on what tax bracket you're in.
So in other words, if a married couple can invest $10,000 in a child's education, it really only costs them $9,500 in our state.
That is correct. That is correct. Now, let me take one step back and talk about other states, because if you have a 529 in any state, the growth on that money is federally tax-free if it's used for education and a myriad of other rules as far as being able to use that money. So as long as you use it for that, you're perfectly fine. You don't get a deduction on the federal level, but a lot of times someone may have their mutual fund company that they work with may offer a 529 plan that is a state other than their state of residence. You're still going to get all of the same federal benefits, but you won't get the state benefits. So one thing that I think it's important to know is if you have that type of plan and you want to put that money into an Alabama plan, you can do what's called a rollover. So you can take from plan A that I'm making this up, but let's say it's the state of Virginia and you live in Alabama, you can roll that into the Alabama plan up to $10,000 per year and get the deduction, the credit that we talked about for Alabama. So that's becoming more and more common is doing a rollover, but you don't really want to do it I don't think all at once because you're not going to get the full credit. So maybe do it over a period of time based on the balance.
So let's say someone has moved to Alabama from another state and they had $25,000 in a plan in Virginia, for example.
Right.
Then over the course of 2 or 3 years, you might do those rollovers to get it into the state of Alabama plan and get that state tax savings.
Absolutely correct.
Absolutely.
Yeah.
That's a good idea.
Yeah.
Yeah.
A couple of other things that we want to address. A lot of people in this day and age have a primary job, but they may do some contract work on the side. They may have a little bit of self-employment income, or they may be self-employed. There are tax savings or an opportunity to do something beyond an IRA, such as the SEP IRA, that can be very advantageous. And there's also other things, other types of expenses that can be written off if you're self-employed. Do you want to talk about some of that? I know one is health insurance premiums for self-employed are not an itemized deduction.
That is correct.
They're off the top.
That is correct. And we go back, we use this word deduction or credit. So the off the top, that's more of a credit. Whereas a deduction, let's say you're in the 24% tax bracket, a deduction means you get 24 cents on the dollar, whereas a credit, you get 100 cents on the dollar. So what a SEP does, so if you're self-employed, and I will say this, Jack and Allison, it's really important that everyone looks at their individual situation because the rules here can get complicated.
Right.
If you are working and your company offers, they don't have to be participating, but if they offer a 401k or a 403b type plan, then your rules changed. Okay. If your only job doesn't offer that, then you can do up to whatever the limits are. So it's really important to look at what is offered at your specific company. If you're married, so for example, in my situation, my wife actually works on my team, but she actually works for RFG. So she gets all of the benefits of RFG. So she has the ability to put into a 401k. That changes what she can do outside of that. So if she had another business, she wouldn't be able to contribute at the same level that I would because my only business is self-employed. So my rules and her rules are a little bit different. So it's really, really important that you work with your tax advisor or your financial planner on this to see specifically what you can contribute. But in any case, it is a credit and it is a benefit to you to put in as much as you feasibly can.
Right. Okay. Mm-hmm. Well, good. Well, we're going to wrap things up here. I do have one other thing that I know is coming down the pipe.
Yeah, I have this question.
This
affects me.
It's going to impact a lot of people. A lot of our listeners, particularly our younger listeners,
we use Venmo, PayPal,
et cetera. And there's going to be some, and they do it for convenience purposes, and it is convenient. But that's going to start being tracked and reported to the Internal Revenue Service, particularly at a much lower threshold beginning in 2024.
Right. So it started January 1. This is an area where I will tell you the rule has changed multiple times over the last 3 years. This is one of those things, Congress sets tax law. This is one of those things.
Not very well, I might add.
Well, that's,
just from my own opinion.
Congress sets tax law. And that's what we have. That's the rules we have to go by. And as I always tell people, sometimes we don't like the rules, but we have to play by the rules.
Right.
And so this is one of those things where some of the congressional bills at the end of the year, at the witching hour, this has been put into place. It has changed multiple times over the last 3 years. What the rule is right now, we may have all heard, this $600 number, that's out the door. What the rule is for 2024, as it sits today, is that if you have 200 transactions or $5,000 into your Venmo, your PayPal, your Cash App. Now, Zelle does not count because Zelle is not a third-party provider. It's only looking at third-party providers. And so if you have 200 transactions or more than $5,000, you will get what's called a 1099-K at the end of 2024. That is going to be a reportable item. So I'll use my example that when we were talking about this, you're one of the lucky ones that was fortunate to get into the lottery to get Taylor Swift tickets. You buy 2 Taylor Swift tickets for $500, and then you put those on a marketplace and you sell them for $3,000. What you did is you just created yourself a $2,500 capital gain. Then at the end of the year, you decide to go sell a couple of $1,000s worth of things on Facebook Marketplace. What happened is your Venmo account or your Cash App account, you just over the course of the year had more than $5,000. Even though it could be less than 200 transactions, you had more than $5,000. You're getting that 1099-K. What it means to you is you're going to have to report those items, and you're going to need to keep really, really good records as to the things that you sold. That's where the rule is, and that's what's going to be a big difference for 2024.
Interesting. So be aware of that. You may have some taxation impact if you use these applications in a great way. I know some people that, for instance, are in bourbon clubs or wine clubs. And so they may be buying cases of wine and then allocating part of it and splitting it, and people paying each other with Venmo. You may end up, if you don't have the right documentation to offset against that, you may not be making a profit at all, but you are doing it for convenience. But the IRS won't know that it's that way unless you keep good records.
Right, because it's going to be a reportable item.
Correct.
Correct.
Okay. All right.
Now we have one more question. So there was a new tax law, maybe around 2017, that came out about causing some younger people to pay more and not get refunds.
Okay, so here we go back to my buddy got a refund, and I didn't get the refund, and I'll take 30 seconds to go backwards. The Trump tax laws that went into place in 2017, that's what a lot of this was. The rules totally changed. Everything we've talked about, standard deduction, itemized deduction, a lot of that thing changed. A lot of those changed. We took away the personal exemption. Here's what's interesting, and we'll go back to this Congress question. Under current law, and I'm gonna emphasize that, unless Congress changes it, a lot of what we've talked about and a lot of the rules that are in place today, December 31st of 2025, they go away. And it goes back to the way it was in 2017. Okay. So it's going to be really, really important when we talk about tax planning, not necessarily tax preparation, but when we talk about tax planning, that we look at what is the rule today in 2024? How does it affect me? What could change in 2025? And then really what could change in 2026? So I think it's really important to talk to your advisors about this. Now, Congress could come in and totally change everything, make everything retroactive. I personally don't think that's going to happen, but it could. But that's under current law the way it is right now.
And I will tell you, for somebody, of course, you're not as old as I am, Jim, but you've been around a while.
That is true.
And not many people are as old as I am, but you have been around a while. And one of the things, my advice to everyone is we can only work with the law that's in front of us today. We don't know what the laws will be, and they'll change. We have seen tax laws over the course of our entire careers change multiple times. And sometimes you get an idea of what's coming down the pike, and sometimes you don't, and we can't control that. So we can only work with what's available to us today. But rest assured, tax laws will change, will evolve over the course of time. And that's why it makes a lot of sense to work with financial advisors that have some knowledge about taxation, to work with good tax preparers if you're not equipped to be able to do your own taxes, to have somebody that you trust. And so with that, I'd like to say, Jim, how does somebody reach out and contact you if they're needing help with taxes?
Yeah, so we have a great website. It's cmcfp.com. That's our website. It has all of our contact information on there. We're in Birmingham. We're in the RFG corporate office is where we're located, and that's the best way is to go there.
And if somebody, one of our clients or friends that listens to the podcast needs help reaching out to Jim and wants some tax help from Jim, we can connect you as well to Jim. Jim's been a dear friend for a long time, and we can do that. So, Alison, how do they find you?
Well, you can email us at info@eaterfw.com.
And that's ITER. Remember, that stands for that's the Latin word for journey or pathway. And I'm Jack at eaterfw.com.
Okay, guys. Well, thank you so much. And thank you for listening today. Please like, follow, and share this podcast with your friends and family. Until next time, I'm Wendy McConnell.
Thank you for listening to the BamCam podcast with Jack Burnette and Alison Castellano from Eater Financial Wellness, a financial advisory practice at RFG Advisory. To get in touch with us, visit today's show notes or go to our website at www.eaterfinancialwellness.com. That's ITER financialwellness.com. And please click the follow button to be notified when new episodes become available.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guests nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory or RFG, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.